Today we are going to discuss the topic is accounting convention and conservatism and full disclosure. Accounting conventions are the systematic norms and framework which should one business follows while doing accounting. These are the fixed conventions and assumption based conventions. There are in this video we can discussing the two conventions. First one is the conservatism, second one is the full disclosure. So, definition of conservatism. It is a conservatism emphasizes cautious approach of financial reporting. It encourages accountants to recognize potential losses or expenses sooner than profit and gains. Means conservatism principle said that accountants or companies should be record all the materialistic or the losses which is anticipated expected losses should be recorded in the books of accounts instead of uh, gains. If they not anticipated gains, that's not problem, but they have to compulsorily recording the as per the conservatism principle. They have to record the anticipated losses. That means uh, we can take one example, that is if a company suffering from any court cases and the company predict that they will lose in that case, they have to early record the anticipated loss for that case for the company. Second one is the principle of conservatism. There are the principle means the the way you follow the conservatism, that is matching principle, recognize expense is in the same period as the revenue they generate. This ensure a fair representation of profitability. Here is also they have mentioned that particular year losses have to record or revenue record in the particular period. That means if the company generate revenue in 2024, they have to put or record it in accounting of 2024, not to early or before accounting. Then the lower cost or market inventory should be value lower cost or market value, representing potential losses in a value, and the anticipated losses, as we discussed, that is they have to record the anticipated losses, not to gains. Next one is the definition of full disclosure. This is the second conventions of our today's topic is that full disclosure. The company should have to full disclosure their material expenses or all the monetary transaction in the books of account. Means companies have required the sufficient information to investor to or stakeholders. Means if they provide the sufficient information regarding that monetary transaction, the investor should take the proper decision on the basis of their uh, their their financials, and beyond the financial statement, it also covers the relevant information and significance of uncertainties. The company also predicts the uncertainties, and investors should take decision as per their report. Next one is the importance of full disclosure. Importance of full disclosure means investors should follow the some investor or company should follow some importance for give importance why full disclosure is important and company should follow it. That means investor confidence. Full disclosure builds investor confidence by providing transparency in company's operation and financial health. Means if the company or accountant disclose its full totally correct uh, accounting entries or the disclosure of the monetary transaction, the investors is confidence to take the decision on behalf of that report. Informed decision making, that stakeholders can make assuming or predicting on the behalf of the decision. Accountability, that companies accountable to financial performance, ethical practices and transparency. In that it's helped to companies to build their goodwill and their strong picture in the market, that they are very transparent in their and they are very transparent in their accounting, that investors should new investors should attract towards their companies. It is beneficial also for them. That means its full disclosure are principles convention says. Here are one case study that loan practical example that loan loss provision, contingent liability, earning per share, management discussion and analysis. Banks must set aside provision for potential loan losses, reflecting the risk of default. Means here are also we take example of banks that banks also predict some uh, future losses. That's defaulter who do not will pay the loan. They will put them into the future losses or defaulter list. Contingent liabilities. Companies must disclose potential liabilities such as lawsuits or pending regulations. Yes, we are there discuss about this. That is pending regulation or lawsuits. They are so put that that's contingent liability, which is not regular liabilities. It can be predicted for future liability. Earning per share. Companies must report both basics and diluted earning per share, reflecting to the potential. Then management discussion and analysis. This section provides qualitative information about the company's future prospects. Thank you.